Well, hello there and welcome everyone to the Advisor's Edge podcast. I'm your host, Rob Jacomen. And listen, guys, we have a really exciting topic for you today. This is a hot topic right now. And I'm just going to say this. If you are a RIA or in the financial services industry and you're wondering what happens when there's market volatility and what the impact is going to be on your business and your firm, in terms of the portfolio risk, we're going to talk about business risk. And obviously we have an expert on the show with us today, my sidekick and co-host, Chad Ramberg. Chad, how are you doing today? It sounds like you're really fired up about this because there's some things going on right now in the market that you want to share with our listeners, anybody who's listening and watching. This is going to be intense and it's going to be, I think it's going to be some high value stuff going on here.
Well, I hope so. What we're going to do is we're going to talk about what we're seeing out there. We know there's a lot of fear in the market. If you're looking at the VIX, some people call that the fear index, right? And it's gone up. And so what we want to look at is what does that mean for the advisors and their business risk and what's happening right now. So it fires me up because I do not like to see, I don't want to ever sell on fear or anything like that, but gosh darn it, we have to look at what's going on in the world. We have to take a clear eye view of it. And fortunately, we get some interesting insights every once in a while. And this is a subject that, look, for our clients and the prospective clients that we talk to, this is a very small sliver of the business, right? It should not be taking up a huge amount of their time. But it goes very deep. It cuts right to the heart of your business. So what we want to do, especially for those advisors that if they're a small office and they're 200 or 300 million and they've worked decades building up to where they're at, they want to protect what they've got. If they're a multi-billion-dollar firm, they've got a fiduciary duty for their investors to make sure that they're protecting it. And also, of course, they want to make sure that their employees and their clients and there's lots of fiduciary duties going on there. So this is just stuff that we want to, this is what I get passionate about it because everybody's working hard to be successful and help their clients be successful. So let's go deep.
Well, you know what? And let's also be very clear. This is also what you're going to talk about is something that's near and dear to my heart as well. And that is helping businesses become lower risk in times of uncertainty and volatility. And this is one of those areas that we are both very passionate about because our mission and purpose is to help better protect businesses that we work with. And you, Chad, specifically for the RIA and financial services industry, this is something that you are built to do and something that you really wanted to share. In fact, so much so that we actually altered our schedule, our podcast recording schedule, to schedule today's Friday, and we could be having an off day with our families or doing something really fun. But you know what? We are dedicated to bringing insights and knowledge and things that are current events that are going on in the world and bringing them to you so that you have more knowledge, more understanding, and a better action plan to be able to say, hey, you know what? I'm going to execute on this thing that Chad's talking about. And just being proactive. You never know. This could be the one thing that could protect you from something that could be catastrophic or a potential loss. So that's why we're very passionate about this. And our mission is just to help you become better. And so Chad, why don't we dive into what we wanted to share today? Do you want me to share the screen?
Not yet. First thing is I want to push back on you a little bit because I know you like that. We love to sharpen our steel edges, right?
Absolutely.
Here's the thing. Sometimes you want more risk. And so risk can be a real benefit. And so this is something I learn from our clients all the time. My father-in-law, who taught me a lot about business, he says, Chad, here's the thing. You do not always want to offload that risk. If you offload all your risk as a business, you are not going to make any money. But we want to be smart about that. And we want to make sure we have the right tools at the right time. And we want to see that risk and say, is that a risk we want to avoid? So both of us are a little bit contrarian sometimes. So I wanted to throw that out there at you. And because there are advisors, I'll give you an advisor example here. their expertise in market risk, this is the right time for some of them to really excel. So this is where it gets interesting, and it can be a lot of fun.
I'll tell you what, I'll push back on you, not just because I think we're actually in alignment on this. I will say this. When you are strategic about risk and you understand and you have the information and the data to make well-informed decisions, and by the way, when you have the proper protections in place, it allows you to be a little bit more risk-taking rather than risk-averse, because you're not constantly being held back or have that bottleneck or that thing sitting out in front of you. Oh my gosh, there's this, I can't do anything. It's just like the analysis paralysis thing. But if you are armed with knowledge and data and information that can enable you to make better decisions for your business, that enables you to be a little bit more risk-taking, have that little bit more risk-taking mentality. So I think you and I are definitely in alignment on that, and glad we cleared the air.
Amen. Absolutely. And here's an interesting thing that a guy taught me, Dustin. He knows who he is. What you're doing with insurance is you are you're paying a known amount for an unknown risk out there. So it's a set amount. You know what that premium is for a huge risk that could be coming down the road to protect against. So, and we could talk all day long about what a nasty claim looks like, hundreds of thousands, sometimes millions of dollars. They're huge in this space. So data is our friend. Validated data is really important. So when you're ready, we can jump into the charts.
All right. So just for those of you who are listening to the podcast, what we're about to share is we're about to share a graphic. And what I'm going to do is I'm going to include the graphic inside of the links in the show notes so that you guys can have direct access to it free. Obviously, it's something you can just download and take a look at it. And that way you can follow along with us as we're sharing this graphic. So those of you who are watching on YouTube or any one of the other platforms, you're going to be able to see this graphic that Chad shared in advance. And we're going to walk through this step by step. All right.
All right. Yeah. So if you're a client or you've talked to us in the past, you may have seen this graphic before. This has been updated. I just updated it. And what we're looking at here is any advisor we talk to is probably going to be able to really quickly. In fact, when I'm at a conference, I put this up and I just ask them, what's that green line? And they're like, well, that's the S&P 500. Okay. All the way back to 1997. It's the weekly close of the S&P 500 up to December of 2024. Okay. And then this orange line here, this is annual claims count. Okay. And what's really interesting is you look at this just at a glance, what an advisor is going to say is we have an inverse relationship to claims against the stock market. So we see a few key times here. And this is not ground shattering. It's common sense is what you would think. People either lose money or they think they lose money, claims are going to go up. So that's the obvious part. Looking at this, we start to see some interesting correlations. We see here in 2001, it doesn't happen immediately, but there's always a kind of a hangover. And we have the claims that went up because we had 9/11. And then, of course, we had our next big market shock here in 08, 09. So 08 was when things started to hit, claims climbed, they peak in 09. And then essentially we've got overall a downward trend in claims right here. So that's interesting in and of itself. One of the most interesting things I saw in 2020 was everybody remembers 2020 and the market pulled way back, but it bounced right back up. So we still are seeing today, looking through 2024, claims volume going down. Now, what's interesting is at some point, every trend changes. So here's why this becomes important to me. We get a trend change, and this orange line starts to reverse. It will not reverse unless there is a lot of volatility in the market and people are getting cranky or upset. Okay. And you don't see on here, you don't see the last week and a half, right? But everybody knows what it is. So for the really smart leaders of firms, advisors out there, you see this. What do you think this tells you? I'm going to ask you directly here, Rob, since you're here with me. If you're a firm leader, you're the CCO or the president of a firm, what does this make you think?
Well, it makes me think that as there's changes or there's volatility in the marketplace, there's a direct correlation to the uptick in the number of claims. So one of the things I would be thinking about as a firm owner is, do we need to be proactive in how we communicate to our clients so that they can anticipate and better understand and be educated on what's happening in the market? So that the market's a very an emotional thing. So people have a tendency to make decisions based on emotion versus on data. And it's our job, I think, as a leader to reach out to our clients and be more proactive in how we communicate and educate them on what's happening in the market. Because that's, to me, that's what I would be thinking about. What's in the best interest of my clients? It's education and knowledge and being able to share them. Yep. And being able to share with them what's happening.
Absolutely. And the good advisors better already be doing that. Okay. And we see there, we have, I don't know, it's going to come out in the next couple of weeks or so, another interesting firm that does compliance that we talk a little bit about that in there. But there's also additional things here for the CCOs. So this podcast is really probably for the CCOs and presidents of firms. Okay. You're really good advisors out there that are in the front lines. This may not be really helpful. This is for long-term health of your organization and setting you up really well in the next 5 years from a business risk standpoint. With this orange line going down, and this is public information and carriers already know about this, the cost for claims has been going down. So that means the cost for premiums have been going down. We're seeing not new entrants into the market, but the way it works with carriers is their appetites are opening up. They want to take on more risk because they see overall claims going down. But they're also very cautious because everybody knows at some point the trend reverses. The real question is, are we at how significant is this market situation we're in right now? Hopefully it's relatively short term and we come out even stronger. I know that's what everybody's working towards, right? But we don't know. If we knew, hallelujah. But here's one thing that we do know, okay? We do know that insurance carriers are cautious, careful, and slow. So that means that we have a unique opportunity right now, because I can tell you that the leaders at insurance firms that are pricing this are really watching things carefully. And at some point, we get an uptick here in claims, the market is going to harden up. Okay. And what's the best example we have today that everybody knows about in a hardening market?
Well,
what do you think it is?
I can tell you, are you asking me what causes the hard market, or are you asking me what other industries within insurance are being impacted the most by a hard market?
Yeah, who's being impacted the most on a hard market? No, so I do the Socratic method because that helps you think really deep, and this is that important. So that's why I'm asking you, Rob, and you're going to be my guinea pig. So what market right now does everybody know about that things have just gotten tougher and it's a harder market?
Oh, by far the auto situation in P&C. That has been impacted. That has impacted businesses far and wide, because even if you have a fleet or you're in the transportation industry, you are just getting beat up right now with the market. So the auto market is a challenging one, not as much on the work comp, but definitely GL. On the general liability, definitely there's been an uptick, and that's obviously a very hard market. So, and that's impacting, and it's being impacted by a number of factors globally. So I want to actually step back for a minute. Hold on a minute here.
Yeah.
I want to step back for a minute, because you and I did an episode back in January where you were looking into your crystal ball and you were actually talking about what happens and what impacts a market globally. So you talked about global conflicts. You talked about inflation. You talked about some of these things, some of this uncertainty in the global markets in general. You talked about how the pandemic impacted markets. So you actually looked into your crystal ball because you said, listen, we don't know what's going to happen because there's a change in administration in the United States, the most powerful country in the world. There's a change in administration. Sometimes there's a lot of uncertainty with, we don't know what's going to happen. We don't know what kind of policies they're going to implement. We have an idea of some of them, but we don't know how they're going to impact global markets. And we're actually starting to see the emotional response to the tariff situation, which we don't know what the tail is of that just yet, but we can anticipate some of the things that are going on and be a little bit more proactive in how we strategically think about our businesses.
Exactly. So what's been happening? The market I was thinking of is homeowners, because if you're in Florida or if you're in California, just getting coverage is a challenge.
Oh yeah.
That's a hard market. So there's a great example. You're right on, because in the property casualty space, which we're property casualty, but in the professional lines, it's a little bit different. Here's my key concern. So this is the thing that you want to know. When that trend changes, the market's going to harden. Hardening market means prices go up and it's harder to get quotes. That's just what a hard market means. And just talk to a homeowner in California. Okay. Yep. And so that's gonna happen eventually in your E&O for your financial advisory firm. Is that going to happen by the end of this year? Or is that going to happen in the next 5 years? I don't know. But at some point it's going to happen. And given the volatility increase, you've got a shot across the bow. Yep. So my advice to you is talk to a specialist. Make sure you have a review of your current coverage. And you do it this year. If your renewal isn't until November or December or January 1st of 2026, so be it. I would still have a review so I can be ready, and I know maybe there's some small tweaks that really should be made, but you really want to know and be ready, okay? Alex and Brad on our team, fortunately, Alex was blessed with a beautiful baby in the last couple of months. He's back in the office. He's working his tail off. He's got some free time, okay? He would love to help you evaluate it. Brad is a skilled veteran in financial services, okay? They are here to help you understand so you can make those good choices. And that sounds self-serving, but I'll tell you what, it really isn't. This is for you. And take the opportunity when you can, because these things, once they start to shift, we cannot change that. We're just going to have to react. And my job is to help make sure my team is ready to help you make better decisions. If we can't help, we'll let you know. Okay. But I want to give you a couple examples if you don't mind.
Well, I want to take a step back. I don't have I don't have a mountain lion in this fight here, and I'm using mountain lion instead of dog. Because obviously I'm not affiliated with your team. Obviously we work together, but I will tell you this. I've been in this industry almost 2 decades. And I can tell you this, when things like this happen, there is no downside for you as a business owner to take the time to have a strategy call, a meeting to talk about what is your game plan. What you do the same thing for your clients, because you would want to say to your clients, listen, let's sit down, let's have a strategy meeting. Let's look at your portfolio. Let's look at all the different things that are going on in the market, and let's have a game plan. Let's have a strategy. Now is the best time to have that conversation and discussion. So there's absolutely no downside to having this, and you should, because let me tell you why. And Chad, you can fill in here because you're the expert in this, but I'm also an expert in insurance and understanding that client experience and that relationship. Yep. The most important thing is to make sure that you do not have any gaps in your policies, in your program, that are potentially leaving your business exposed to more risk, or what I call financial impact or potential financial impact. There's one thing about taking risk, but it's another thing that if you have a gap or an exposure in your current program or an exclusion that you didn't even know about, that maybe you're working with a generalist right now and your generalist doesn't understand the financial services industry. So they don't know that, hey, if you don't have trade coverage or you don't have some kind of really unique, Chad, you can share more about this and what you're seeing. But if you don't have certain coverages that are unique and custom tailored to your industry and those exposures, you're just leaving your business exposed. And you're basically rolling the dice, hoping or praying that nothing bad happens. And right now, that's not the case in the market. So you have to be extra careful, very strategic, and proactive. So you can feel the level of passion and enthusiasm I have about that, because my mission throughout my entire career was, I want to put those walls around that fortress that is your business that you spent all those years building. And in a snap of a fingers, something can really catastrophic happen or bad happen. And guess what? All that work, all of your employees, all the people who are counting on you to run a successful business, all of a sudden now you're putting them at risk. So anyway, I'm going to get off my rant.
Well, this may be a little bit of a rant of a show, and that's okay. I want to give you some examples of some real life things where we've helped out clients. Okay. And then I'm going to give some, look, I don't want to sell on fear, but here again, we got to be realistic about how things look. Okay.
Hey, can I ask you quick? Can I stop you before you go into that? Because I think it's really important to put things in context before you share some of these examples. Because the thing that was going on in my mind is I'm imagining myself as a leader or managing partner or chief compliance officer for a financial services firm. And I'm asking myself right now, Chad, what are some of these scenarios or things? What's the reason why you have that correlation between the market, the health of the market, the S&P 500, and the incidence of claims? What is the cause, the underlying root cause of those claims? Is it more emotional? Is it more, hey, I need to just educate my clients more? Are they just freaking out for no reason? Like, what is the primary driver of those claims?
Yeah, so I'm looking off into space here because I'm thinking through claims that we see. Okay. So when I go down into the root cause of that, the first thing I look at, and as a business leader in my firm, financial firm, first thing I want to know is, well, we're getting 1 to 2 potential claims. 2024 was a low claim year, 1 to 2 potential claims a month. Okay. And that's not a big deal. The answer is when you got enough clients, life is happening for somebody every day out there. Okay. And then what we see right now is it's amped up. Now we're right potentially at the beginning of this, or maybe it'll cool off. Who knows? But we're right now getting about 1 a week. Okay. And then that number might go up. Now, what's driving that? The first initial thing that drives it. So in the last 2 weeks, 2 things came up. Okay. One firm, there was a tax situation where some tax advice was made. The client didn't actually do what the advisor said to do. And it put them in a situation where they have to go back and adjust their taxes. But then what the root cause of it coming up for the RIA, now this is a bit larger firm and they have an arm that does some tax support. But what ended up happening is they were both on the tax side and on the financial advisory side. And he said, this is going to cost me money. He's going after him, even though it was the client's decision. Okay. And this is where it gets goofy. As you dig under the hood, most of these, the clients are getting upset because they're looking for blood and they don't care where it comes from. They may even still love you as an advisor, but they're like, look, I don't care. I'm out $1 million. I want some of this money back. You had a hand in the pie. You didn't have a hand in the pie. You were there to help them. You gave them probably the best advice for what you knew at the time when you were there, which was exactly what happened in this scenario. Okay. And then later on, you'll learn something new and they're upset. They're emotional. They're going after it. Okay. That's one thing that we can see. Another thing that recently come up is a trade error. And it's really simple. When the markets are this volatile, if you have a stop order, either buy or sell, that can get triggered unexpectedly. And then maybe the market reverses and you want to undo it. And okay, that could be a trade error. Or maybe not. It's how do we navigate through that? Because guess what? The market moves so much, I'm out a lot more money than I thought. So now that's an emotional thing that comes up emotionally for the firm first. The clients don't know about it. The really good firms who are set up, they have a really good business risk plan in place. They give us a call. They say, hey, I've got this situation. I'm trying to get it resolved. How can we get this resolved? Protect our clients, take care of them. And by the way, we don't want to open up our risk anymore. So what's the best way to communicate this with our client base? If it affected a whole bunch of them, the scenarios go all over the place in that situation. Okay. But it typically is generated from an emotional standpoint. And here's the real challenge about it. When you have the fiduciary duty for your clients, that means you put them first. Now, as an organization, you have to be financially profitable. Otherwise, you're not going to survive. So are you putting the client first when you're making a good business decision for the business? Or are you putting the client first because you're sacrificing a little bit of profit to take care of the client? That is debatable. So when you have the fiduciary duty for your client, that's why these can get very expensive to defend, because it's hard to prove. Now, obviously, in your mind, you're doing the right thing for the client. And when we talk about client, sometimes it's not that specific client, it's the client in the aggregate. So that's all your clients. Yep. Okay. We have to think about all of that. So that's where it can get really dynamic, because you can have one client that comes to you that's upset, maybe for a valid reason, maybe for an ill-valid reason, but they can claim that, look, you did not put me ahead of you. You did not meet your fiduciary duty. In plain words, you put your firm ahead of my needs. Okay, now what? Well, that's where we need a really good, strong attorney, and you have a choice. If you've got really good coverage and you know how that's going to go through, or you have a really good idea of what that process is going to look like, then you're a lot more confident. You can say, okay, we're going to deal with this. We're going to take care of it. You're going to have help, and we'll get through it. It doesn't disrupt the rest of your clients. To the point you made early on in the show, Rob, that's why good insurance is more valuable than the premium that you pay. And certainly, we hope to never have to need it.
Yep. And that's why it's so important to work with somebody who is an expert in that industry that you're talking about. In your case, the financial services industry. So, Chad, I think you're really talking about something that's really important on the RIA side. How important is it for them to have very clear documentation as far as the advice? Because if they have a fiduciary responsibility to their clients, how important is it to document everything and have every I dotted and T crossed?
Well, I laugh because we're in an interesting time right now with AI tools that you can have out there. For example, note takers and stuff. And cameras are cheap. You could record everything. Probably not a good idea to record everything. Okay, because your clients want you to be real, right, and be upfront with them. Yep. But at the same time, you want to have the right information in there. And also a lot of good advisors can be really good friends with their clients. So it's more than just a financial advisory thing. It's personal lives get involved in the work that our clients do with their clients, right? So it's about finding a good process. So I'm a process guy, finding a really good process so you get those key advice points done. When we get into claims, the root cause of them is all over the place. They typically come through as very logical, but when we get to the heart of it, it's usually an emotional reason. And advisors will not be surprised by that at all, because it's really simple. You may have an unrealized gain or an unrealized loss. If you have an unrealized loss and the client's looking at their statement, they think they've lost a ton of money, that can start an issue. Now, where it gets nasty is yes, the market's down. Maybe we made a slight hiccup somewhere. Not a big deal. You can get it taken care of. But the clients use that as the leverage point to claim breach of fiduciary duty.
So let me ask you this, Chad. Why don't clients get upset when they have a massive gain in the marketplace? I'm being sarcastic here, but also at the same time, it's like the emotional side is it's people's money, and people get very emotional about money, but they get very excited and happy when things are going well. And then they question like, hey man, I'm looking at my statement here. What's going on? But I would imagine if a financial advisor is proactive about before that statement goes out, or if they're continually educating their clients, I would imagine that it's probably a little bit more effective if they're more educational and proactive.
Yeah, it reduces the risk when you're educational and proactive. So there's the good news. That's the best way to reduce your risk. But because we are in a risk management game, that's what the advisors are doing. We're not at Box Professional. We're not an expert in financial risk management. That's what our clients do. Business risk management is where it comes into play. So you're right. That business risk management is proactive, educating your clients is what it looks like. Your question is funny to me because you're right. There are mistakes that happen. We see trade errors that are positive. And people usually don't get upset about that. Although what gets interesting is the other reason, if there's something that starts out negative and then it turns positive, we have seen situations where the client is a little upset and they're going and talking to somebody, but we got to remember that third party, that's the attorneys. And an attorney can look at it and say, look, you can claim whatever you want, but if it's not going to get you in a better position, why would you do it? Now, some people do things for spite, but the good news is attorneys can see through that pretty quick. And they're usually going to advise their clients, look, it's in your best interest to go ahead and shut it down. So we've seen some really goofy things like that, but it's yes. The first thing, money thinks value goes down. Doesn't matter, realized or not, value goes down. How do I get that back up? That's usually what the clients are thinking. Somebody's whispering in their ears, oh, maybe your advisor made a mistake here. And then it's a matter of getting the big guns out. Who typically wins are those that have the biggest, best attorneys to support their side of what happened.
And that's one of the reasons why you have this kind of coverage, is to make sure in these situations that you have somebody who's on your side who can advocate and provide you with a defense and dive deep into the data and information. Because that's a lot of people don't understand. Chad, this is actually really, this came to me all of a sudden, because I don't think that you and I are experts in insurance. I don't think that my clients, when I worked with them, I don't think that they truly understand or understood what is the life of a claim. What happens with a claim? I don't think this is even talked about very much in this industry. Is if we could track the life of a claim, like what happens? A claim is triggered. Okay, this happens. A client gets upset. The claim happens. But then what, Chad? Like what's the process? How does it unfold?
So trade error claims, super simple, super quick. Okay, let's say you have a trade error, and this is super quick. You might laugh at this. So you have a trade error, you find it within a week or two. Let's say it's a $100,000 trade error. You go in there, you take it to the carrier. Your clients don't know about it yet. You take it to the carrier. You have your deductible. We see this is what happened. This is what we intended to happen. Okay, a check gets written. Everything gets resolved. You notify your clients, done. Super quick, done in 3 months. Okay. If you're really lucky, it's done in a month. That's lightning fast in this space. When you have A typical claim, and the really nasty ones, is where you start to get into breach of fiduciary duty, and it doesn't matter how small whatever initiated it, doesn't matter emotional or wherever it came from. The more meat there is, or the more things that the attorney can sink their teeth into to try and recover some money, is the longer it's going to take. So it's really, and these are expensive claims, and this is why it gets expensive. 2 or 3 years is not unusual. Okay. A long claim is going to be 5 to 10 years to get resolved. 2 years is okay. We got through this fairly effectively. If you can get it done in less than a year and you can spend less than a few $100,000, look, it's not comfortable for anyone, but that's not horrible. So this is what, when we talk about severity, that's why we talk about it. And the claims are interesting because you see the claims are way down, but carriers are really smart and they have a lot of data. Even though the minimum premium essentially hasn't changed for about 10 years, okay, they know that when those claims start to pop, it's going to get really painful. For carriers, what is, you say, really 2 or 3 really profitable years, and then you get a year or two where it really is painful for them because they're spending more. It's not unusual to spend more than what they brought in premium. And they've got a lot more expenses than just that. And they're a business. So like you or I, they got to keep operating. They have to make sure they're strong there for the long term. And we want them strong for the long term.
We do. And that's something also to educate our clients on, is when you're talking about the lifetime of a claim, every claim is unique. They're all very different. They're managed very differently. But as long as you have an advocate, you have a specialist broker who understands and can help you navigate those claims. That was one of the greatest advantages I had. I understood the claim side so well because I dealt with a lot of transportation, contractors, like a lot of heavy claims types of classes of business. And just being an advocate for them to be able to say, hey guys, listen, here's a claim. Let me show you how we're going to navigate this. We're going to help you manage everything, walk you through it step by step. By the way, that's the greatest thing that a broker can do for a client, is when something bad happens, that they go into this action mode where they become an advocate for their clients. And that's what you guys are like. That's what you guys do. You have processes built for this. And by the way, for anybody who doesn't know, Chad is formally from the claim side. So you understand how that game is played.
You may be sitting in a situation as a principal or a CCO of a firm where you say, hey, that sounds a lot like us. Okay. We had actually, they didn't end up becoming a client. We told them it's not the right time, but it was a really interesting situation. He was about a month within the renewal. And he says, this is what I've got. It seems a little interesting here. I don't know that I'm getting the best deal I can. We looked at his policy. We walked through his situation, built a RIA view for him, talked him all the way through it. We said, you know what? We're so close. We don't want to jump in the midst of the negotiation of the renewal. But here's some things that I would be curious about. He took that information, took it to his current broker, and he saved 10% on his renewal. Okay, now, certainly we don't like to do work and not get paid for it, but we're here for the clients, right? Or we're here for advisors, and he's not a client. He's still not a client right now. It's about $1 billion firm. So that was not an insignificant situation for him. Now, God willing, he'll be working with us next year, probably will, but it's worth it, okay? Because things are so soft. This is how crazy it gets. We get another situation, and this actually I get more often than not. If they're not working with a specialist, we go through that process. We find out maybe they're a firm that they have a specialty focus and they know a lot about a certain alternative type of investment. Okay. And so they've got some exposure to alts, and we go through the whole process with them. And guess what? We find that what they have as alts is actually not an alt because it's got a 40 Act wrapper around it. Okay. An advisor may be an alt specialist, but they may have structured their business in a way where they get those access to the alternative investment types in a way that's as plain vanilla as possible. Smart business move, okay? Because in those situations, it's really easy to save 10, 20, sometimes even 30% on the premium. Not an unusual situation, okay? Now, another situation, that first example I gave is really simple. The only reason that can be done is because of that downward trend we were looking at the chart before, okay? And that wasn't even changing carriers, which we like to and appreciate carriers that are sticking long-term with the advisory clients. We appreciate that and we want to support that, right? Because that's what we need in the long run anyway. We're very careful about that. The other thing that ends up happening sometimes, on a renewal with a client this year, they added an SPV. So they created their own private investment, which typically can very easily double the premium on coverage. And when we went through it on this one, when there's a big change in a business, say you change strategies, you expand, maybe you've grown a lot, it's not unusual. You want to make sure, double check, go a little bit deeper in the underwriting process. What we were able to find, we were able to add coverage for that SPV and save them in premium. Unheard of. Never ever heard of that happening. Okay. I was surprised on that. But this is how soft the market is today. And the key thing is, I would be amazed if it stays that way for very much longer. You want it, there's your trick. That's your tip. That's the hot tip. If you've got this far into the podcast, that's what you need to know. So how do you take advantage of that? It's really simple. Call Box Professional, talk to Alex, talk to Brad. I'm a little bit harder to get a hold of. Sorry. But if you need me, we'll get you on the schedule there. And what we'll do is we'll help you look through it and make sure you're getting the best that you can get. And if we can't, no harm, no foul. At least you know what you know.
100%. So you know what, Chad, as we're landing the plane here, because I think we're at that place now. Let's do a quick summary and recap, because we covered a lot of ground today. So one of the things that we started off the show today talking about why it's so critical right now because of the volatility and the uncertainty in the marketplace, why you should be proactive and have a strategy, have a game plan. Now is the best time to sit down with a trusted advisor who specializes in your industry, like Box Professional. Sit down and have a review of your whole program so that you have a game plan and you have a strategy. And you guys do something very unique. It's called a RIA view, which
is RIA view. It's silly, I know, but hey.
No, it's awesome. It's branded exactly the way it's supposed to be, which is it serves RIAs specifically. It's a custom tailored whole review of your insurance and risk management program. These guys are top notch. They're the best in the industry. That's all I have to say about that. Secondly, is Chad, you talked about a lot of the responses when situations happen like this with clients, and why it's so important for advisors to be proactive and educational in their approach. Why is that important? Because if you can be proactive and preempt something ahead of time, and you can educate your clients on why things are happening, explain it to them. Hey, this is happening. This is what I recommend. This is my advisement, or this is my advice as your fiduciary. This is what we recommend. You guys are the experts. That's an extremely important part of this. And then Chad, the third part and you can embellish in or expand on any of these. The third part you talked about is, okay, when a claim does happen, how do you navigate that claim situation? How do you go through the process? What is the process so that advisors have a really good understanding and also a sense of security and comfort? Hey, I know I'm in good hands. I know things are going to be taken care of. I understand the insurance marketplace way better now because I've listened to Chad's podcast, and now I have a thorough understanding of how the system actually works and how I fit into that and what's in my best interest for my clients as well. So we covered a lot of ground today, and I think is And this is like one of the best episodes, but I think the beginning part of this, where you're talking about the graphic and how the market, the S&P compares with the incidence of claims in the financial services industry was fascinating.
That's right. That's right. And I'm a big believer in validated data. Okay. Don't take my word for any of this. And the beauty of working with financial advisors is they know their stuff. So here's another tip for you. You probably looked at it already, but go look at the VIX. And when you pull up the VIX, pull up maximum data so you can get it back all the way to 05. And you just look at the three peaks. When did they happen? 08, 2020. What are we looking at on the VIX right now? It's a little bit below 2020. And for a moment there, intraday at one point, it looked like it was maybe above 2020. I'm looking at daily data, not intraday. But you look at that, and then you can say, look, the VIX, that's a fear index. Fear drives claims. Okay. Don't take my word for it. Common sense, go look at that. Give us a call. We're happy to help. That's what we're here for. This is why everybody on the team here really likes working with the clients that we work with, because they're smart. We got interesting conversations, and we're here to help. So
love it.
Hope that does it for you. Guys, thanks for taking the time today to think about this. I think it will hopefully benefit you tremendously.
Yeah. And guys, thank you so much again, I'm reaffirming Chad's gracious comments here and how honored we are that you've taken the time to be part of this show and part of our journey. And obviously we're always looking for input and feedback. What's important for you guys. I, as well as Chad, we talked about this yesterday. We thought this was a really critical time in our history. And I think we see inflection points throughout time, and you can start to see trends. There's trends. If you look back and you look at the data, you can start to look at things in a way that gives you a different lens. It helps you make better decisions when you have access to data and information, and you're working with true trusted advisors like Box Professional who specialize in this industry and can give you really sound advice and advisement on how to go about this whole entire process, how to have an ironclad insurance and risk management program that's custom tailored for your business. And I know this wasn't a pitch for you guys, but I believe in you so much, Chad, that I'm willing to go to the end of the earth to share with anybody I know in this industry to work with a true trusted advisor and your team. So you guys are top notch, you're world class. And guys, wow, we covered a lot today, and we're extremely grateful that you hung around as long as you did here. And I'll put all the links in the show notes so you have access to all the data and information that we see and that it's important for us, so that we can help you make better decisions and we can have a positive impact on your business. So guys, we will see you on the next episode of the Advisor's Edge podcast. That's it for now. We'll see you soon.
Thanks, guys.